and welcome to Smart Money. Now, on the occasion of Children's Day, we decided to move out of the office and head into the Edelweiss office to meet Radhika Gupta, the MD and CEO of Edelweiss Asset Management. She needs no introduction, of course, but she's a new mum, so she has a new job as well to handle. And Radhika, first of all, congratulations on the new role that you have assumed. It's a great time to talk about planning for your child, right? Because you are a mother now, and you know anything and everything about investments given your long trajectory and your career. But tell us a little bit about how you're feeling as you enter this new phase.
I'm feeling good. I would describe it as beautiful chaos. So it's chaos. I don't want to say that life is perfectly sorted between a CEO role and a mom's role and AMFI vice chairman and the 500 things I do. But it is beautiful. It's wonderful to walk home and have someone smile at you. It's fantastic. Beautiful chaos.
Like someone once told me, it is the most exhilarating and exhausting experience at the same time, motherhood, right?
It is exhilarating and it is exhausting, and it is both in the same day, sometimes in the same hour and in the same 2 minutes. But I wouldn't have it any other way, and I think I couldn't have thought of a better time to have a child than this. So I think it's worked out the right way.
And it's been a great journey for you, right? I mean, after such a long stint, a successful career, now you've embarked on motherhood. But it also brings us to the point about investments, because we tend to get so lost in this daily rigmarole that we forget about investing for our child. So let's talk a little bit about that. I mean, since it's Children's Day, when is the right time to start investing for your child?
I genuinely believe as early as possible. In fact, my husband and I were very clear that as soon as we had our son Remy, we would start the process of getting his Aadhaar and his PAN and all his docs in place, because that, of course, precedes investing. So we got all that done. He went to the Aadhaar card office, got his little cute picture taken and everything. And he's about to make his first investment actually next week, because he just got his bank account open. I think really the earlier the better, for two reasons. One, of course, we've all talked about compounding. So I think the power of compounding is immense for children, and the sooner you start, the better. Secondly, we all talk about influencing children and the importance of children learning financial literacy, the importance of how to manage your money, the importance of valuing money in the first place as they grow up in a more prosperous India. And I think what better way to teach them about managing money than them having their own investments in the first place.
And, you know, we did an episode last week on the occasion of Children's Day itself, where the expert was pointing out that nowadays children find it very hard to know the difference between want and need. When we were younger, things were very different, and now, as you said, a more prosperous India, you need to kind of instill those values. But when you talk about the power of compounding, right, there's so much that you can do for your child, so many options out there. Where do you start and how do you decide?
So I think you want to keep it simple with children. Children have a long time horizon, which means they have risk appetite and they need wealth creation. So equity is, of course, the right asset class, I think, for children. If you're looking at long-term investing, I mean, for my son, we're looking at 18 years, definitely, right? So equity is the right asset class. I think within equity, what we are going to do, and I think what works for most children, is index funds. They're simple. You're finally buying India's growth. It's a child growing up in a prosperous India who's going to benefit from the economic growth from India. So you want to look at equity index funds, which will give you that long-term India equity growth. You don't have to worry about which fund manager, what will happen over 18 years, because 18 years is a long, uncertain period. So index funds are a way to cut out that uncertainty and just give them the India growth.
Okay, so that's on the equity side, which I will come to in detail later. But what about other asset classes, and what about other schemes, right? Whether it is, say, FDs or corporate FDs, Bharat Bond, you have the Sukanya Samriddhi scheme. How do you decide how much to put where?
Okay, so I think finally you have to do an asset allocation for your child, and asset allocation is very personal, whether it's for an older person or for children. If you want to add debt as a part of your asset allocation and you're doing long-term debt investments, then I think long-dated target maturity funds. For instance, you can do a 15-year target maturity funding. We have a 2037 fund. You can lock in rates today, and rates are high today, incidentally, when we're having this conversation, for a 15-year period and then realize that. So a long-dated but tax-efficient option, I think, could work nicely. The second asset class, I think, that works well beyond domestic equities is international equities for children. The reason is many of us will want our children to study abroad. Now, when I graduated from college from Wharton, fees were 40,000 US dollars, and I think the exchange rate was 40 or 50. Wow. Cut to today, the exchange rate is 80 and fees are probably $70,000. So you want some benefit of that dollar appreciation. So you can take money and park it in a foreign equity index fund or a foreign index fund, some part of it for college education.
Okay. So you said foreign equity fund for, college education, right? If you had to look a little more deeper into the Indian equity space, if you want to sort of start, now I have a 5-year-old and I want to start investing for him. How do you decide whether I need to get into large caps, mid caps, small cap funds? What should the kind of, portfolio look like, the model portfolio?
So children, because they have risk appetite, I think some kind of multi-cap approach works to children. I'll tell you what we are doing, with our son. Now, we have an index fund called a large and mid-cap index fund. So it has 50% large cap exposure and 50% mid-cap exposure. A pure large cap portfolio, I think, for children, in my view, is a little conservative. They want, they need the alpha of mid-caps. Now, you can debate small caps, etc., etc. But I think this 50-50 combination, which we have in a single fund, that's one that we're going to do. An SIP approach works well for children. So parents can start saving month on month, take a portion of their monthly savings and just allocate it to the child. And then they can top up the SIP as incomes rise, needs rise, etc. So I think a blend of large and mid cap or some kind of multi-cap approach works really well.
Okay, and within passive funds, what are the options that you would suggest? Say, for children, I will come to actively managing your portfolio next, but within passive funds itself, what's the approach?
So I think the passive equity fund range is very vast today. That is the good news.
And it's very confusing as well, right? For people who, for you and me who've tracked the markets for long, we know our way through. But every other parent I meet tells me that I'm so confused, I don't know where to put the money.
Seriously, because there are large cap things, there are small cap things, there are smart beta things. What do you do? So I think I'm going to name a couple of things I like. As I said, I love this large and mid-cap fund because it's just one simple option. And if I did nothing else for my kid and just did this, I'd be quite happy in a single fund because parents have a lot of parenting to do besides managing money for their children. Within equity index funds, there are also other options. So you can create your own combinations. You have mid-cap passive funds, you have small-cap passive funds, you have Nifty and Next 50. So you can take all of these and make your own combination of a multi-cap portfolio. So that's one very nice thing you can do. I think those are, and then you have a bunch of debt passives, as I said, that work really well.
So, if you're looking at long term, right? You said you're investing for your son for the next 18 years. Now, we live in a world where there's so much digital disruption every year.
Yeah.
How do you deal with that? A sector that is in flavor today is suddenly become redundant tomorrow. Do you just ride it out, or do you take stock of your portfolio every few years that you've invested in for your child and change your approach? How does it go?
I don't think you worry about that too much because 18 years is too long a period to predict, right? So I think you go with a diversified fund approach and you really go with the belief that if you're investing for 15 or 18 years, as long as you get the India growth story plus some alpha, as long as you get some combination of large, mid and small, and you get a cross section of sectors that works. One of the nice things about index funds is that indices are self-selecting. So if IT as a sector is growing, market cap of IT companies will grow and it will be a larger portion of the index. So you will get that growth, maybe with a lag, but you will get it in passive funds.
So do you have a historical, a summarization of how perhaps the Edelweiss funds have done? In the last, say, 5 to 10 years, have the index funds beaten the benchmark? Have they beaten passive, active funds? What does the data suggest?
So I'll give you two data points. One is of a fund a combination that we're launching, and one is of a fund that exists today. we did a combination portfolio of 3 funds that are coming up for launch. Very, very simple funds. A Next 50 index fund, which all viewers are familiar with. A mid-cap momentum fund, so which is 50 mid-cap companies out of the mid-cap universe. And a small-cap index fund. These 3 in a combination, and you can pick the mix you want. You can pick 50, 25, 25, you can pick 40, 30, 30. On a risk basis, they're actually similar to actively managed funds. On a return basis, they outperform by a couple of percentage points. The other one so that's a nice combination that you can make, and you can tweak the things. You can tweak the choices. If you want to be more conservative, you add more Next 50. If you want to be more aggressive, you add more small cap and mid cap. The other one that we've done is for our large and mid cap index fund, which is the one I talked about. I think that beats most large and mid-cap active funds quite handsomely.
Oh, really?
Yeah.
Okay, well, I do want to talk a little bit more about that, but I'm going to take a small commercial break. Be right back in a bit, in moments from now, back on Smart Money.
याद है पापा जी के रिटायरमेंट एफडी आज उसे तोड़ने जा रहे हैं। उन्हें रोकते भी तो कैसे, घर भी तो चलाना है। और तुम तो टर्म लाइफ इंश्योरेंस लिए बिना ही चले गए।
पॉलिसीबाजार.com पे 1 करोड़ का टर्म लाइफ इंश्योरेंस सिर्फ 430 रुपए महीने से शुरू।
Last hour. Anything can happen between the bells. But what happens during the last hour is what matters the most. The biggest market swings. A close-up look at what's driving them. And how the investors are reacting. Watch the most seasoned market mavens guide you through the most important hour of the trading day. NSE Closing Bell. At these times, only on CNBC-TV18 and CNBC-TV18.com.
Powered by LIC. हर पल आपके साथ.
Get up close with the movers and shakers of the Indian startup economy.
We don't have a mission, we have passion. We look at being able to back more than 500 to 600 brands across different categories.
I like to find the gap in the market and support brands that would require the springboard that I can bring in terms of my platform and see potential of growth.
India is the fastest growing digital payments ecosystem in any of the large economies. We are very excited about how we can ride that wave and how can we continue to be front runners.
India's most comprehensive daily show on startups. Startup Street celebrates 3 years of showcasing India's startup story. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com. From David to Goliath, from the smallest business ventures to multi-million-dollar global corporations. Meet the movers and shakers. Today's newsmakers. tomorrow's leaders. Understand what makes markets move, how companies make quantum leaps, and how giant corporations stay ahead. Get the biggest business stories of the day, power-packed into 30 minutes. On Business 360 at these times.
Welcome back. You're still watching Smart Money on CNBC-TV18. We're here speaking to the MD and CEO of Edelweiss Asset Management, Radhika Gupta, and we're talking about how to plan for our children and invest for their future. Radhika, before the break, you were telling us about how this, multi-cap combo index fund, so a group of index funds together, is something that you can create for your child and perhaps prepare better for his future. Tell us a little bit more about it. What is the combination that I need to have, different scenarios, and what are the kind of returns I can generate?
Sure. So let me walk you through the components, because I really believe the combination is something that you can customize, and in our presentations we've given options for combo. So the first part of the component is the next 50. Now that's an index everyone is familiar with. After the Nifty, which is the top 50, it is the next 50 companies in India, the next 50 largest companies. So you're really benefiting from leaders there. That's what I call your anchor in your safety. The next component is a mid-cap component. It is your mid-cap of the 150 universe of mid-cap. It's the 50 companies that are showing momentum, price momentum, so that are sort of really doing well. So it's the Nifty 150 momentum index. And then you have the small cap 250 index, which is the collection of small cap companies. So that is the combination. I think for a conservative investor, you could do 50 in the next, 50 and 25 in the other two. You could also do 40, 30, 30. And if you want to skew it more towards mid and small cap, perhaps you can do 25 and split in the other two. So you can really make your own combination of indices. As I said, I think when you look at the combined basket, the drawdowns are very comparable to your market-based indices or your active funds, but the returns tend to be, I think, about 1 to 2% higher on a compounded basis.
Over the long term.
Over the long term, which is meaningful. I mean, again, you're investing for a long-term period. And remember, this is without an uncertainty factor, and this is with very moderate costs. So the other benefit of this index fund combination for parents is that it is a very low-cost thing, and low costs matter over a long period.
Absolutely. Have you noticed that a higher percentage of small caps and mid caps in your combo fund will give you better returns over the longer term?
They will, and they will give you, the mid-cap momentum index fund, for instance, is a high return combination. It beats most mid-cap funds in any case without too much drawdown. So adding mid and small cap definitely will add that juice, but that's the choice of the parent as to how much risk they can take or want to take for the child.
A lot of parents and people in general are confused about whether to go in for ETFs or index funds, right? Just clear the air here, and what is it that parents should do for their children?
Okay, so I tend to be a little biased in terms of index funds, and I'll tell you the reasons. I think ETFs are great instruments, but they're meant for traders. I think when you're investing for your children, you are not a trader. You're really investing for the long term. ETFs and index funds are both tracking the same underlying indices. So I could have a small cap ETF, I could have a small cap index fund. Both are replicating the returns of the small cap index, giving you exposure to the best 250 small cap companies. ETFs work like a stock. You need a demat account and you can trade them. Index funds work like a mutual fund. You have the entire mutual fund structure. You can do an SIP, etc. I think for parents, the need to not have a demat account, the need to worry about calling a broker, trading, etc., and the ability to do an SIP also, which is very powerful for children. Index fund format works better for most people.
Okay, so index funds over ETFs any day, right? We also talk about how to plan for your education of your child post 18.
Yeah.
So how do you decide which mutual fund or which index fund outperforms up until then? I mean, it's a long time period that we're looking at.
And that is why, I think that you almost can't figure out what will outperform in 18 years. If you were to ask me what category is going to outperform in 18 years, if you were going to ask me which AMC is going to outperform, which scheme is, it is very hard to guess. I mean, look back 18 years, the mutual fund industry has changed colors completely in terms of what's on offer. And, forget 18 years. In 5 years, we see that the best performing scheme of the last 5 years is nowhere today. So why get into that guesswork? That's why the case for passive funds. I mean, I personally invest in active funds for myself, but for my child over 18 years, do I want that uncertainty factor? Can I take that bet? Probably no.
And do you take stock of your child's portfolio every 5 years? Because a lot changes, right? Sometimes you bet on a person, you bet on the fund manager, you bet on the group.
Yeah.
But things change over a period of a decade or so. So when do you take stock?
I think you should take stock of your child's portfolio every 3-4 years. As your child is perhaps going to college, getting older, the need for cash flow probably increases. So it also depends on what you're building that portfolio for. But the child's need in terms of wanting to withdraw from that corpus could increase. So if your child is 13 or 14, maybe you take stock of the portfolio then, make your portfolio a little more conservative, plan for education when he is 18 or 19 and 21, add a little bit of fixed income. Maybe you can add a 4-5 year target maturity fund so that when he's 18, you have a certain corpus in hand. I think the first 10-12 years when you don't need the corpus are ones to really build the corpus.
And what about gold? Sovereign gold bonds, gold ETFs, anything like that you would add in your child's portfolio?
I would not do it simply because over 18 years, I think equity outperforms as an asset class. So I don't need the hedge against inflation that gold solves the purpose for.
Okay, so now we're going to do a quick rapid fire on not just parenting, investment advice in general. I know none of us are experts here. We're just learning along the way.
Least of all me after a 4-month-old. So I'm no one to give anybody advice. I'm a taker of advice.
Actually, I'm a bit more mature mom
Exactly.
compared to you. So maybe I should be
Exactly.
throwing
You
the
should be
advice
giving me
at you.
advice.
But the only advice is that there's no advice.
Correct.
Okay, so let's do a quick rapid fire, right? Let's start with that. One investment advice that you would give new moms or dads.
Investment advice, I think more money advice, Sonia, I would say. Teach your children to value money.
Okay, well, it's hard for adults to value money.
It's
as
hard
well
for
these
adults
days.
to value money, but it's really hard for kids to value money. And I think the earlier you can instill that in today's India, the better.
Okay, what's the one investment mistake you would avoid?
What's the one investment mistake? Doing very complicated things, especially for a children's portfolio. Really, you can get away by being very simple. And the second thing I would do is avoid being very late.
Okay, start early.
Start early.
All right, that's my next question. What's the best time for parents to start investing?
Now, literally now. Do it as soon as your child is born, get the setup done and get started. And as they grow up, start talking to them about it.
Okay, 3 top mutual funds that you would advise for your children.
So I would do, a large and mid-cap index fund, which I've talked about. I would add some flavor of, small cap and mid-cap. And if your child is going to study abroad, I would definitely add an international portion.
Okay, and how much should the international portion be?
I think you have to work out the rupee corpus. So if you can try to work out the cost of education, you should try and cover some part of it in international. Okay. Now, education is expensive, so you may not be able to do a lot, but it could be a meaningful portion, could be 25-30% also.
Okay, all right, given the way the rupee is
Yeah,
going.
so I mean, US dollar fund.
Okay, and finally, your biggest learning as a new parent?
My biggest learning as a new parent is that, two. One is that you shouldn't be so harsh on yourself. I think moms tend to be very, very harsh on yourself. And one of the things my mother told me is that no mom is ever going to do anything bad for her child. No mom goes out there to be a bad mom. So remember when your child smiles that you're not a bad parent. So don't have guilt. And secondly, I think children role model the behavior they see in adults. It's the same learning I've had as a CEO. So be the parent you want your child to be the human being you want your child to be the leader you want your team to be.
And enjoy the ride.
And enjoy the
way.
ride. You know, it goes by very quickly.
Radhika, always a pleasure speaking with you across topics, across sectors, and now with this new role, I wish you all the very best. Thanks so much for being a part of our Children's Day special on Smart Money.
Thank you and happy Children's Day.
Well, with that, it is curtains down on another special edition. Keep writing to us. We love receiving feedback. Until we meet again, stay safe. Well, Nigel, 2021 has been